Okay, so here we are, just getting up on 11:10. So welcome to this week's CEDAR Financial Risk Seminar. Today, I'm delighted to introduce my friend and hopefully someday soon collaborator, Vic Khanna, who's a professor at University of Michigan Law School and Syracuse Law School. I didn't know that. Oh, no, I see.
No, my co-author is.
Okay, so you're not in two places.
Yes.
Vic's in Ann Arbor, one of my favorite places on the planet, and talking about a subject that we've looked at from many different perspectives, ESG investing. This is insuring against wrongdoing and socially responsible investing by mutual funds. So please take it away, Vic. And again, everyone, no questions until slide 2.
Okay, thank you so much, Lisa. And I'm delighted to have been invited here and to be here to speak with you. I'm looking forward to your comments and suggestions. And do let me know if you can't hear me. I'm still trying to figure out how to do a microphone through a face mask. So let's see. All right, so our paper today is about insuring against wrongdoing. And what we're really doing in this paper is we're sort of taking a bit of a dive into the types of factors that may motivate use of ESG considerations. And what we're doing is we're examining whether mutual funds tilt their portfolios towards more socially responsible investments, or SRI, in response to fund controversies. And the fund controversies we're looking at are filing fidelity bond claims and filing errors and omissions claims, which I'll explain when we get into the data a little more. What do we find? We basically find that a mutual fund that's making a fidelity bond claim typically increases its SRI score or tilt in the claim year, but not in the year before or the year after. We provide evidence that this is causal and robust and consistent with mutual fund behavior around other controversies, like the mutual fund scandals in 2003 and 2004. Of course, the issue becomes, why are mutual funds tilting their SRI scores after an FB claim? Essentially, the reason is an FB claim is a negative signal. A fidelity bond claim is basically when the mutual fund claims that one of its employees has engaged in larceny or embezzlement with respect to fund assets, or put more simply, that one of the fund managers has stolen money from the fund. As you might imagine, that tends to terrify investors. And so one response to making a fidelity bond claim that we sort of found here is that when you tilt a little bit more towards SRI, that seems to reduce the negative flow effects from the fidelity bond claim. And this is mainly centered on the funds that are increasing their SRI tilt the most. That is, they're in the top quartile of funds that are increasing their tilt. We also find that it reduces the returns or the performance, again, primarily for the funds that are increasing their SRI tilt the most. That these tilts are very short term, they're just one period. And indeed, we also find that the funds that increase their SRI also tend to have the least managerial turnover. So one way to sort of summarize our key findings are that these funds are using a temporary increase in SRI tilt to repair their reputation, which is reducing negative flow effects, that is money moving out of the fund, and also reducing the risk of managerial job loss. But they're doing that at the cost of burning returns. An interesting finding we also have is that funds almost never make a second fidelity bond claim. Now, what's interesting is they may reveal in their documents that someone has stolen money, but they won't actually claim a fidelity bond. That is, they won't claim an insurance payout for covering that loss due to larceny or embezzlement. And indeed, it turns out if they report that they've lost money, but they don't make a claim, there are a few negative effects that arise from that. You don't see a flow effect, you don't see any other sort of real effect, suggesting in some respects maybe that it's the newbie funds, the newer funds that make the fidelity bond claim, and they realize after burning returns that maybe they don't want to do that the next time and they just eat the loss. What are some of the contributions? Well, one, of course, is we're providing some evidence of the use of socially responsible investing to repair a reputation after a negative signal, focusing on the client's reactions. And also we take some steps to address endogeneity. There's some policy issues that might be triggered by this. That's why I put the question mark. That is that these SRI changes are benefiting managers by saving their jobs. that might make one think that there's some scope for legal regulation or thought on this, primarily because, of course, if this is being done to benefit managers and not investors, that looks like an agency cost. These changes are very short term, again, sort of raising some suspicions about what they're for. And I'm going to present a few new results today that where we sort of broke up our data into funds that are only retail oriented and funds that have a mix of retail and institutional. And it turns out that the SRI tilt is only being done at the funds that have some institutional investors. So they're not being done at retail funds. And our suspicion for that is essentially that it's only really institutional investors that think that an SRI tilt is going to help you repair your reputation when you claim a fidelity bond claim. Okay, that's slide 2. So happy to take questions once I get into the gist here.
I got a question already since we're at the end of 2.
Perfect.
Can you go back to the previous slide?
Okay, fair enough.
On it. So when you say reduce SRI score after an FB claim reduces performance primarily for funds increasing SRI the most. So is part of your claim that this move to SRI reduced performance?
Yes.
Because as we've discussed, there's a big pile of evidence on both sides of that question, vehemently arguing that it's the truth.
Exactly. We don't want to overclaim because we're really just talking about here how tilting SRI in response to a fidelity bond claim seems to burn returns. But yes, this is evidence that we think of, it burning returns.
Thank you.
Yep.
All right. I'm sure you're going to get to your data, or maybe it's
sure.
maybe on this slide. But
no,
what was your prior in terms of why there's a relation, why there would likely be a relationship between fidelity bond claims and SRI changes? Why were you thinking that could be a relationship?
So it basically comes from what's called the halo effect. The notion being that sometimes if you do something good that earns you a halo, that can sometimes overcome or at least reduce some of the negative effects from something bad you've done. I come at that basically as someone who studies white collar crime, or at least one of the things I look at is white collar crime. And we've seen in the context of FCPA violations, companies increasing their CSR or their corporate social responsibility efforts, either in response to an investigation or in response to a conviction. Now, that of course is not targeted directly at their clients. This one is targeted directly at clients, or at least that's the understanding. So we sort of suspect that it's plausible that relying on this SRI tilt is a way to essentially create a halo effect, repair your reputation when bad news about your fund managers comes to light. Now, one of the interesting things which we'll hit upon again later is the market doesn't seem to have a negative reaction if you report a loss, but don't make the fidelity bond claim. It seems to be triggered on the bond claim, which I guess is maybe more visible, or at least it sort of suggests that bad stuff is happening at the fund. Whereas if you just eat the loss, it suggests that maybe you understand that that's the best strategy to adopt. We can talk about why later. There are lots of interesting sociological stories for why that might be, but we haven't canvassed those yet fully. But yeah, it comes from the halo effect. Cool. In fact, that's actually exactly where I was going next. So thank you for the segue. So as you know, this is just background to why we decided to look at this. There are many motivations for looking to ESG considerations in investment, business decision-making, etc. This is just a sort of a potted summary. You've got product quality signaling, Milgram and Roberts, delegated giving, that's Becker, halo effect, as we were just talking about. In fact, that's the oldest one, going way back to 1920. And in fact, probably earlier, because if you were a student of history, you would sort of know that oftentimes people who do bad things later proceed to donate to churches and things like that. Maybe either as a way to cleanse their soul or just to make themselves look better. There's also other reasons why you might favor ESG considerations, for example, attracting certain types of investors and so forth. We're really focusing on one particular story in the mutual fund setting, which is, do mutual funds attempt to tilt their portfolios towards SRI in response to fund controversies, which is basically a version of the halo effect. And as I mentioned, there are some papers examining related issues about firms engaging in additional CSR to basically curry the favor of law enforcement when they're facing future sanctions for white collar crime type behavior. Okay, so now, of course, socially responsible investing is not the easiest thing in the world to measure. So we adopt a very simple measure that's used in the mutual fund literature, which is we're going to basically treat your SRI score as 100% minus a percentage of your portfolio that's in socially sensitive industries. What are those socially sensitive industries? We're sort of borrowing that definition from Hong and Kaspersky, JFE 2009. These are basically sin stocks like alcohol, tobacco, gambling, firearms, oil and gas, things like that. And so, for example, if you see an SRI score of 90%, what that means is that only 10% of your portfolio is in socially sensitive or sin industries, as an example. And this is really just designed to measure the extent to which a fund is screening out these socially sensitive stocks. All right, our data. Our claims data comes from the SEC Form NSAR. This is filed twice a year. And basically the key questions, it's a lengthy form, but the key questions we're most interested in are, were any claims filed during the period under a fidelity bond? Now, a fidelity bond is something that mutual funds are required by law to buy. It is basically an insurance policy that pays back the fund a certain amount of money if the fund claims that a manager has stolen from it, essentially. Another type of thing the form asks you is, were any claims filed during the period under an errors and omissions policy? That's basically, did the fund lose money as a result of an error or an omission, as opposed to theft by an employee? They'll ask you what are the amount of the losses, and they'll also ask you, are there any losses that you incurred that you did not file a claim for? So this is sort of how we get data on losses where you're not filing a fidelity bond. All right.
I have
Yes.
some clarifying questions.
Sure.
Just to learn more about the fidelity bonds. So if some trader for your mutual fund or somebody who is working as an analyst somehow got inside information on an oil or gas company, that's not something that would be, that they could get prosecuted for. That's not something that would get included in this bond.
That's correct.
Okay.
It's only, yep, go ahead.
Sorry. And then the other one was sort of just thinking more about this, like how many are there, and what's the spread over time? Was it really concentrated, say, when we had this whole oil spill and stuff like that, or is it more spread out?
It's spread out. There is something of a small peak in 2003 and 2004, because that's when you had the mutual fund trading scandals. So there are more cases then, but there's some every year. I think our total data set is, I think, 220 or so unique FB claims over the 16-year window.
One more thing, I'd just be really curious if you looked at it. So I think it's an interesting setting and haven't heard about it, but the letters, because a lot of people have started, and it looks like you're going through the SEC anyways, their annual letters from the mutual funds, if they
It's a good idea.
mention why they actually, basically get rid of their oil stocks. I mean, I can totally see the halo effect, but I'd be curious how they justify it.
Yes, let me just make a note of that. And just remind me, this is being recorded, right? So that I'll be able to hear the comments later too.
Right. So the last question about accompanying disclosure, I think, is a good one.
Yes.
And I have an obvious question. I'm sure there's an obvious answer, but why didn't you look at lawsuits filed by shareholders and other stakeholders?
So we did begin to look at those. The trouble is they're not always that easily found, and it turns out that this particular form allowed us to get more granular detail than we would have gotten with the shareholder claims, because this is something the fund itself is claiming. So we can treat it as a floor in some ways. But we've been sort of gathering a little bit of information on the suits filed. One of the things to note is that the amounts at times that are claimed for the fidelity bond are on average not very large. So we're not very confident that they would generate a lot of shareholder suits. They're typically less than $100,000.
It seems to me, from an investor's perspective, it's a bad and worse. The bad news is you hire crooks. The worst news is you then fritter away returns to try and paper it all over.
Yes, and I think that is exactly why you don't see funds filing a fidelity bond claim the second time. They learned from their first experience that wasn't the best thing to do, so they don't do it again. But I agree with you. I mean, one way I read the data, because the amount for the fidelity bond is typically between, I think, 30,000 and 100,000. It's sort of like, the bad news is we've hired a few crooks. The good news is they're kind of inept. They only managed to steal, 50,000 or 100,000. But that unfortunately means that there's unlikely to be a lot of shareholder suits for that, because that's just such a small amount. It's unlikely that they're going to generate the kind of cases you would hope you'd want to get as data.
Well, that assumes, and it may be the case, that the amount filed under the fidelity bond equals or exceeds the amount of the actual loss. I can see circumstances under which a company would file under a fidelity bond for significantly less than the probable loss. Provability is one issue.
Provability is one issue, but they would actually have to still disclose the amount that they lost as one of the other questions on the form. Now, of course, they might fudge that, but at least they would, in theory, be required to. And it is interesting. There were a number of firms, not a majority, but a number that did disclose a loss, but did not make a fidelity bond claim.
Thank you.
Sure. All right. Now,
along the lines
Yeah,
of
go ahead.
the litigation, I think you're right that you wouldn't expect to see litigation against the funds, and the private right of action is so much harder anyway.
Yeah.
I just wanted to mention two data sets that might be interesting for you to just react to. One is, so Adam Badawi and I have been looking at the relationship between those kinds of securities class actions and ESG metrics.
Oh, cool.
And so we've found a relationship between them. That
Excellent.
companies with higher ESG scores are sued less often and are likely to have the lawsuits dismissed, and they settle for less. So sort of a similar kind of, it's very much in
the halo effect, yeah.
Very much in sympathy with your paper. So that's one
Very
thing
cool.
we can talk offline about that.
I'd love to.
And then the second one is, I don't know if you've seen Rob Jackson and Colleen Honigsberg have this paper where they look at infractions by fund employees and the incidence of those. I wonder if that overlaps some with.
That's a great idea, actually. Yeah, both of those are great ideas. So offline, I'll be delighted to talk more about your paper. But also, I did see Rob and Colleen's paper, and it's funny. It didn't even dawn on me that would be a good data set to look at. So that would be excellent for us to look at. I'll email them and try to get access to it. All right.
Frank, I'd love to see that paper too, if you have a preliminary draft or a summary. Thank you.
Cool. So just another word on the data. These are basically plain text files, and they're not in other electronic databases. That means we basically, code them. And there are only a handful of studies that are using this, but most of them are focused on fund leverage. Oh, hang on. Sorry, 1 minute. All right, this is 17 years of data from 2000 to 2016. And then we merged it with the CRISP survivorship bias-free mutual fund database. And we're focusing on open-end mutual funds as noted in the paper. Okay. All right, so just to give you a sense of sort of what the SRI score looks like when you break it up into the funds that are making no claim, that's the dotted line at the top. Funds that make E&O claims, which is the middle line, and then funds that are making FB claims. And what you can see is, just visually, a pretty marked increase from T-1 to T, and then a reversion back, it seems, in T+1. So about almost as short-term a move as you can get in some ways. Just for clarity, the scores along the vertical axes, we've taken the fund's SRI score and subtracted away the average SRI score of its investment style. All right, so here's some summary stats. If you look at the funds making the fidelity bond claim, what you basically see is that they're smaller funds, they belong to smaller families, they're younger funds, and they're more expensive. They do seem to have greater returns. They seem to have lower institutional ownership. The overall impression one gets is that the set of funds that are in the fidelity bond claim set are basically younger ones that are sort of more risky, shall we say, at various levels. The reason that's going to be important is when we think about the narrative here, one suspicion one gets is that these younger firms are essentially making the fidelity bond claim without realizing that it's going to cost them a lot in returns and other things. And once they experience that, they move away from it. All right, so here's our main result, right? This is the change in the SRI score when you make a fidelity bond claim and an E&O claim on the lower panel. So on the upper panel here, you can see that in period T, there's a statistically significant increase in the SRI score for those funds that are making fidelity bond claims. As you can see in T-1 and T+1, it's basically 0. So that sort of kink function, the upside down V, is sort of being borne out in the basic regression as well. All right, we use fund and style fixed effects throughout. All right, just try to get a little bit of a second. And sorry, yes, go ahead.
Can you go back a couple of slides?
Sure. To the main regression or the one before?
The one before that.
Yeah, sure. There you are.
Okay, so if I look at family size,
yeah,
I see the fidelity bond claims are just about the same as for no claim.
Yeah.
So something curious here, so it seems to be smaller funds, younger funds, but I would have thought the decision about whether to file the fidelity bond claim would be made by the fund family.
That's a great question. We've been trying to figure that out because it's not entirely clear to us how these decisions are being made because, again, the amount is not huge, but very few funds seem to do it the second time. So you would think if you're in an experienced fund family, they would discourage their managers from filing fidelity bond claims, exactly along the lines you're suggesting. But we haven't yet found any evidence one way or the other to tell us, like, at what level is this decision being made? The form doesn't actually tell us. We've sort of thought that it might be helpful to actually speak to some fund managers and get a sense as to at what level this call is being made, precisely for the reason you're mentioning, because it seems odd if they're part of a fund family that that's not being at a higher level. It's plausible that maybe these fund families of the ones that are making claims are smaller, so maybe they don't have all their systems as, shall we say, set up as some of the other ones, but we don't yet know the answer to that.
Thanks.
Sure. All right. In an attempt to sort of have more robust results, we actually start sort of looking at SRI scores using matching methods and using an instrument. We match on distance and propensity scores, and then the instrument we're using is custodial spending. The notion here is that if you put the funds in custodial services, that should reduce the likelihood of there being embezzlement. Hopefully, that's the point of the custodial services. So if that's true, then that might make a good instrument on the logic that you would expect a reduction in the number of embezzlement cases, and not necessarily anything related to the SRI score. The results are basically robust across this. We then go and sort of try to do another sort of measure of robustness to say, okay, well, what is this like a consistent behavioral pattern we're seeing with mutual funds? So we look at basically the late timing or market timing scandal of 2003 to 2004, and we basically see a very similar pattern, which is in T-1, very little, T+1, very little, in T, an increase in SRI tilt that's statistically significant at the 1% level. Coefficient's a little smaller, but basically the direction is the same. So, this is sort of going to the notion that this is not this seems to be a pattern in some ways, that every time something goes wrong, that suggests sort of bad behavior at the fund, you're seeing an attempt to tilt SRI scores for a very, very short period of time. Okay, now, assuming for the moment that the SRI scores are tilting the way we're suggesting, what effects does that seem to have, or what effects is that designed to maybe stem off? So one sort of notion we started with was that, to the extent that a fidelity bond claim is sending a signal that, your managers are crooks, or at least some of them are, you might expect to see investors pulling some of their funds out, because why would they want their money managed by crooks? So we looked at fund flows, what we call net flow, and tried to see, like, do we see a decline in flow, or a reversal of flows, a negative flow, for funds that are making fidelity bond claims? And what we find in this regression is that basically, yes, we do see that, funds that are making the fidelity bond claims do have a negative net flow effect. All right. We then broke down the sample further to look at the funds that were in the top quartile of sort of moving their SRI tilt. And to give you a sense of what that is, the average SRI tilt, the average SRI score is around 90, 91%. And the ones that are in the top quartile move from about 3 below that, 3 percentage points below that, to about 1.5 above that. So it's a net change of about 4%, which is pretty large given that you're starting with 90, roughly. For those that are in that top quartile, we actually see that the fund flow effect is largely vacated. You don't see funds pulling out, you don't see investors pulling out as much money from the funds that are sort of tilting very severely towards the SRI score increase, which is kind of interesting in some ways. All right, we then went and looked at other things like fund performance, looking at alpha here. And again, you sort of look at the funds that are making fidelity bond claims, they suffer a reduction in alpha. But again, when we look at the funds that are the most aggressive, again, that top quartile, the basis point reduction there is quite large. I mean, that's 68 basis points in 1 month. That's quite something. Essentially suggesting that although the net flow effect, the reduction of that net flow effect is centered on the most aggressive SRI tilts, so is the burning of performance. That's sort of a trade-off at some level. All right, we then sort of looked at T+1 just in a little more detail to get a sense as to is that change also centered on the ones that are tilting the most to increase their SRI score? And what you have here is basically a table. The low means the lowest quartile, the high means the top quartile. And again, what you're seeing is that the top quartile seems to be the one that is the one that's most likely to dovetail down in T+1. So that basically the ones that are most aggressively ratcheting up in T are the ones that are most aggressively ratcheting down in T+1. Just to give you sort of a
question about the
sure.
About the burning. So could this burning be transaction costs? So it's not that SRI firms are inherently less profitable, but just you take your portfolio, you make a major change in it, and then you change back, and there's some cost in that.
There certainly would be some cost. We don't have a rough sense as to what those transactions costs are. We'd be a little surprised if they were 68 basis points per period. That seems a bit on the high end, but it would depend on how much trading they were doing, how much churning that led to. That seems relatively large. Granted, that's an interaction term, but still, that seems a bit larger than I would have expected for transactions cost. Also, keep in mind that the change in the SRI score is going from, like in the top quartile, it's from like around 87% tilt towards SRI towards about 91% tilt towards SRI. Depending on the size of the fund, that could be large, but it would be a little surprising. If you have ways to estimate the transactions cost, that would be very helpful. That's something that both myself and my co-author have kind of talked about, but been kind of unclear as to how to go and get a ballpark estimate of the transactions cost associated with this.
This is 68 basis points per month.
Yeah.
Right. So and they goes for a year. So that's
it's a lot.
That's serious money. That's like
7% you're looking at.
Yeah,
that's pretty big. I mean, if that's transactions cost, that would be impressive. But like I said, I don't have.
It's also hard to explain that from.
I agree.
From poor returns. If you change 4% of your portfolio, how do you
seems
get
like
an
a lot.
8% drop in your return?
Exactly.
So something strange here.
That was exactly why we were looking at transactions costs, because we thought this was quite large. At the same time, if this were the flow variable, I would be more comfortable, because I can imagine investors reacting very negatively to news that you had theft at your fund, and maybe even more negatively that you filed a fidelity bond claim. So like 2 double negatives. But here, this is just performance. That suggests that what they invested in did really badly, which seems a bit odd. Or maybe it's a little hard to know how to explain that. I agree. It's large for what you would expect.
Nick, I don't know if you have this, but it might help with some of the intuition behind these findings. If you had a few examples, especially of the ones that have the most significant reaction, just to talk us through.
That's a good idea.
Exactly what the changes were, which stocks were purchased and which ones were sold. And then another thing that might be really interesting would be, given that you have these strong correlations, what were the overlaps in the purchases and sales that changed the SRI score? So for example, You know, was there a particular, like if you were to rank the stocks that were purchased and that were sold that had the greatest degree of overlap among the funds, that might help with your narrative to say,
That's a great idea.
they sold Smith and Wesson or whatever it is, you know, whatever it is,
Yes.
just to drill down into
That's a great idea.
what's happening. I'd be
That's
super interested just to know what, you know, what it is that's having this massive effect. It could be.
It's large. I agree. No, I totally agree. It would be very interesting to sort of see that. That's a good idea. I mean, and it would also be kind of interesting what they bought back. Like, do they sell Smith and Wesson and just buy back Smith and Wesson, or do they actually switch to something else? It's interesting because, like I said, usually a fund that claims a Fidelity bond once doesn't do it again. So that seems, you know, intriguing. But it's a good idea to sort of see if we can piece out what they sold and what they didn't.
Vic, in the same direction, I wonder if there are any time-dependent effects, because to Bob's question about comments about the transaction costs, they varied a lot over the cost of trading has varied a lot over the period you've looked at.
That's a good idea. I see what you mean, right? So that's plausible that maybe back in 2003 and 2004, the transactions costs could have been higher, and maybe that's driving some of the results if a lot of our data is from that earlier window.
Yeah, it might be a way to help test out that claim with the
That's a
data
great
you already
idea.
have.
That's a great idea. Thank you. Thank you very much. Appreciate that. Okay. All right. So we were here. Yep. Okay. This is, again, just looking at the funds that aggressively increase their SRI score, what happens in T+1, and you can kind of see that there's a large negative coefficient, meaning they decline down. All right. So then we started looking at, what other things might be, the result or be influenced by the tilt towards SRI. And we figured, well, if a Fidelity bond claim is a partial revelation of bad behavior by management, you might expect, in addition to maybe removing their funds, investors might demand, or top managers might actually fire some of the fund managers. So we looked at changes of managers at funds. And again, we followed the same basic strategy here. We looked at what happens overall, and then what happens at the top quartile. And what we see basically is, again, in the top quartile of SRI tilt, you basically see a less managerial turnover, which might be one of the things you might expect from the filing of Fidelity bond claim. Now, one thing that we've been trying to get information on is who got fired, because that would be helpful to know. But that data is a little bit more sporadically available than the rest of the data. But the basic story seems to be that in addition to stemming net flows, they're also reducing the likelihood of managerial turnover by tilting heavily towards SRI relative to the rest of those who are in the sample. Okay, this is sort of the new result that we added in over the last 2 weeks, which is, if you look, one story, we sort of stepped back and thought to ourselves, look, this is a very, very strange thing, because we're seeing a 1-year tilt towards SRI, and that's actually having some impact, right? Either in terms of flows or performance or even turnover. But it's so temporary, the move, right? It's just one period. Is this really something that would convince investors? So we figured one way to try to tease that out was to divide up the funds into those that have only retail investors and those that have institutional investors as well. So one set of just pure retail, the others either institutions or a mix of institutions and retail. And the logic, our prior, was that institutional investors would care more about SRI tilts than retail investors, on the logic that retail investors cared basically just about returns. So we split the sample and we looked at what we found, and basically, what we found was that they don't typically tilt their SRI score much, at least not in a statistically significant way, for pure retail funds. Most of it is centered on the funds that have institutional money. And our thinking here is that sort of might explain the other result we found, which is no one files a Fidelity bond claim again. One narrative to explain that, but difficult to test, is that you're not being penalized so much for managers losing money, but you're being penalized because you were crazy enough to file a Fidelity bond claim and sort of advertise it to the world. Instead, it seems that most of these funds, basically the next time if they have a loss, they never claim fidelity bond insurance payouts on it, and you don't see a flow effect or anything else. You don't even see them tilt towards SRI. Now that's a very small sample, so I don't want to make too much of it, but that led us to sort of explore this. And this was a kind of an intriguing outcome for us, that the effect is centered mainly on institutions. One puzzle about that is, on the assumption that institutional investors are more sophisticated, why would a one period change in SRI tilt make any difference to them at all? It's not as if you're convincing them that you are now a more socially responsible investor, since the next period you switch back. So that sort of made us think that maybe this isn't so much about convincing institutions that you're more socially responsible, but maybe that this is sort of a signal to them that you sort of now understand how you should be dealing with these losses. So it's more sort of a signaling story than maybe much else, but we don't know. We did probe a little further just to basically sort of see what does this do to the flow effect. And lo and behold, yeah, it turns out that the funds that are the institution that have institutional money are the ones where you see the net flow effect being negative rather than in the retail funds. That's somewhat consistent with it. Like I said, the sample size is not as large as we'd like, so we don't want to build too much on it. But it does suggest to us that the sort of kabuki dance story, for lack of a better word, may be a decent, at least working hypothesis for which to sort of explore some of these results a little bit further.
Vic,
yes.
I have a couple things to say. Could
Sure.
it be that, I mean, institutional investors read news about funds,
Yes.
and maybe
Retail
retail
don't.
investors are on the beach, or
Yeah, that's right.
not paying attention to information that might make them react?
Yes. That's a plausible. I think that's a perfectly logical story. It does seem weird, though, that institutional investors would read the story but then not realize that they've switched back to what they were doing before in T+1.
Yeah.
That just seems odd. Like, I mean, maybe an institution gets, is convinced once or twice by that, but not over a 16-year window with, hundreds of funds. That just seems weird.
Yeah.
To me. So, yeah, I mean, you're absolutely right that it's just, the fact that they're paying more attention could be one thing, but if they are paying attention, then they shouldn't be fooled by the temporary blip.
It's also pretty small R squared.
It is a small R squared. That has a lot to do with the fact that we have not a lot of funds. When you split up a small sample of funds in the fidelity bond claim even further, you have even tinier things. So yeah.
Yeah, and one other comment just on the narrow question of not doing it again.
Mm-hmm.
I don't know if you've ever been unlucky enough to get into a small scrape with your car.
Yes,
but,
I have.
If you submit an insurance claim on that,
yep.
once, you learn never to do it again.
That's
Why?
Exactly right. That's
because
right.
It's more expensive to do it than not to do it.
Yeah, and you're absolutely right. And in fact, you'll laugh. Both the times my car's had a ding was when the car was stationary and somebody else hit it. So literally third-party injury. And I still did not want to file the claims because I knew it would be such a chore. I've been, my co-author was, we were talking just last week about the possibility of exploring what happens to insurance premiums for those funds that file a fidelity bond claim. We don't quite know what to make of it yet, because remember, this is insurance that's mandated by law. So you have to buy it. So in theory, we should actually be able to see something. It's just, I don't know if they disclose how much they pay as insurance premium for fidelity bonds separately than others, or maybe even just generally. If they do, that would be a great thing to look at, because then you'd be able to sort of probe exactly the question you're pointing out here, that they learned the first time is so stupid, let's not do it again. But they do still disclose the loss, which means that if the institutions were worried about the loss, you should see a net flow effect, but you don't. Suggesting that it's more on the filing rather than the amount of the loss. Now, that is because a lot of the losses are not very large. They probably wouldn't be noticed, except that you're filing a fidelity bond claim.
Can I just ask you for some guidance about the form? I put in chat a link to the form.
Okay.
I have to confess I've never looked at any of these fidelity bond filings before, and I don't know if you have them available. But if you go down, it's in page 34 of this. If you want to.
Page 34. Okay.
So So I'm just wondering.
That's almost
like,
as bad as footnote 13, but okay.
I know. So I'm just wondering, in your data, so which of these, maybe you could just talk us through sort of which of these are going into your data set and which are not, because I'm just puzzling through your results and trying to figure out exactly what it is that's gone into your data. So I'll leave you to tell us about this stuff, because I've never seen it before.
Yeah, no, so this would have been the part that my co-author was the one who downloaded most of the data and hand coded it. So I would need to ask him. I did send him the link for this, but I don't see him online here. But what I will do is I will ask him, presumably your question, just looking at this, is sort of, what do these entries mean? Or what part of the form we're getting our data from?
Yeah, I'm just kind of trying to think through. Sorry, I don't mean to have this be a gotcha question. I'm just genuinely
that's fine.
About sort of how we should think about this part of the form, and which. So it looks like there's a fair amount of detail in some of these questions about the amounts, and if you coded the amounts as well, that might be interesting.
We did.
You know that they're small, I guess, so you did code them.
We did code those. That's how we know it's around 50,000 on average. That's correct.
So this might just be something to ask your co-author, but which ones are the ones that aren't filled out again? So when you say they don't fill it out, which of these questions are the ones that they stop filling out? That might be interesting to understand.
Okay.
I haven't seen the paper, but I think it would be really helpful for the reader just to
That's a good idea.
Put these questions in there and then say, okay, what's the deal with these? Each
That's
of these.
a good idea.
We're asking for.
I've just never seen it
before. It's really interesting though.
It's a remarkably detailed form. I was actually kind of surprised. I mean, I thought federal securities laws was detailed. This is like at a different level almost. You know what I mean? But yeah, that seems to be the case. We have sort of puzzled about whether there are policy implications of some of these findings. Like the most obvious, of course, is that if this is being done as a way to reduce the risk of management being fired, that seems like a bad thing, arguably. And alternatively, if this is something that is being done to cater to institutional investors, then funds that have both institutional as well as retail money, maybe the retail investors should know a little bit about this. But outside of that, it wasn't obvious to us if there were strong policy implications from these findings, beyond the interesting fact that this, is a very, very short-run attempt to create a halo effect. Happy to take other questions or comments. That's actually the end of my presentation.
Well, that was great. Lots for us to think about. Just a couple of comments. I asked a lot of questions. One of them is I really love the way you measured the SRI, because there's certainly a lot of that going on, and there's a lot of disparate rating schemes, and of course, a whole literature about that. But the choice you made was really very faithful to the effect you were looking for, which is, maybe revulsion to behavior, and then getting rid of sin stocks. Certainly, that seems to make a lot of sense. Were there any? Maybe you said this. Were there any sin-oriented mutual funds in your sample?
That's a good question. I don't think we looked specifically for that. We could. It would be easy to identify them, I think.
Sure, and it would make an
yeah.
interesting case study. They might behave differently,
Yes.
or they might,
That's a very good point, actually. Yeah, we should look for that, because
yeah,
they would presumably, their investors know what they're doing. So
really. Yeah, and coming back to Frank's point, what would help me, like when I look at summary statistics like this, like they're powerful, but examples would
examples are a good idea. Yeah.
help bring it to life, and also for temporal effects, because while the SRI measure you've picked has certainly been more consistent over the period you looked at than, say, carbon would have been. Like now,
Right.
everybody's all carbon all the time. They weren't so much at the beginning of your period.
Yes.
It'd be interesting to see what stayed the same and what's changed as we moved through time, because this is a very dynamic area.
That's a good point. I mean, sorry, go ahead. Yeah.
No, go ahead. But
I was just going to say that one of the things that we were sort of thinking was, might it make sense to divide up the sample period, 2000 to 2016, maybe divide it into like 2-year chunks to see, are we seeing different effects, or is there particular points in time when things are really more pronounced? Or is this like just consistent across the 16-year window? Our only concern with that is just sample size, but you can address that by just dividing it like in 2, up to 2008 and after 2008, right? So that's a good, I think it's an excellent idea.
Yeah, you might want to leave out 2008, 2009.
Right, because of the
really weird
craziness
time.
of it. Yeah, it was. That's true.
I think Lisa's point about the SIN funds is a really good one, and might be generalizable. So it might be interesting just to divide your funds up into different categories and see whether results hold for certain categories or not others. And it might also be interesting. You probably have included this. I can't remember, but it might be interesting to look at whether your results vary based on fees, based on the.
Oh, that's a good idea.
Right.
Right. That's a good idea.
Hypotheses about that. And then one other thought I had, I agree with Lisa that it's especially provocative the way that you treated the SRI measure, and this narrative about selling some stocks and buying some stocks is interesting. It might also be interesting for you to look at the other the indices of the ESG indices and whether they map over, right? So
that's a good idea.
You could come up with an aggregated weighted index based on like the true value measure or some other ESG measure, and then see whether there's a difference there. There's been such a proliferation of these indices that it might be that you'd have an interesting finding, with respect to those. It might be a pain to do that, and I'm not even sure exactly how you would do it. I don't know if anybody's done that with mutual funds to try to sort of,
that's an interesting idea.
Come up with a weight. Basically, you're coming up with a weighted. Maybe Lisa knows, I don't know, but you're coming up with sort of a weighted mutual fund ESG index based on the portfolio company holdings or something like that. Anyway, I think it would be interesting just to, you'd think that it would, that your findings would hold for that as well. But some of these indices are just not related to just, with the kinds of sales and purchases that you're finding. I don't know. Anyway, those are just some thoughts. I find it, the fact that you found this is super fascinating to me.
I'm very surprised.
I have to confess, I'm just skeptical of what of the mechanism, right? Because what's the story? I mean, I'd like for you to tell me one example of a story. Like, okay, this Fidelity fund had this bond. Don't pick Fidelity, whatever.
Right, I understand. Yeah.
It's a bad choice of words.
I agree.
But they had this bond, and then they sold these 3 stocks or something like that. I'd like to hear what your best narrative is fitting with the mechanism, because I feel skeptical about the mechanism. But it's cool. It's very interesting. So.
It's a fascinating finding. I agree that the mechanism, or even what explains what we're seeing, is weird. So I'm with you on that. It's just that's just the most parsimonious explanation we could find thus far. But yes, I agree. That may be a very good idea to sort of bring in some examples, lay out what they did, and sort of say, look, this is kind of what we see at times. Fair point. Thank you.
Frank, to one of your suggestions about indexes, this is a worry of mine lately, what ESG indexes are like. So for example, the tobacco companies figured out how to get themselves really great ESG ratings, and they're tilted toward in some of these indexes. And a related complication is the kind of best in class methodology used for these ratings. Like instead of getting the carbon emitters, you give good ratings to the least carbon emitters, say in the oil industry. They're right up there. So the way in which these indexes are constructed is getting fishier and fishier. And one of the things I loved about what Vic did is he seemed to manage to escape that complication. But, if you do go down the path of looking at indexes, really spend some time of figuring out what rating scheme they're using and who, you'll find Philip Morris on top and, really great rating for ExxonMobil.
Yes. I do remember seeing an ESG rating that was heavily weighted towards how you treat your employees, and BP Oil came in the top 5.
Sure.
Because they have daycare crashes.
Right. We've looked carefully at Philip Morris's document called "A World Without Cigarettes," and they tell you, we have such great gender balance, on our executive team, and we hate child slavery, and the entire thing has become so corrupted that it's very unbelievable.
Yeah, the ESG ratings is hard. I mean, actually, it's interesting. Our sample period ends in 2016, and correct me if I'm wrong, but do most of the ESG rankings sort of start coming out in 2012 or so, or is it even earlier than that? Or maybe later, I don't know.
I should look. There's a lot more ratings coming. Hold on, let me look at a paper.
Okay.
You give me half a second, I'll try and
Sure.
try and give you an answer to that question. Where am I going to look for that? Maybe here. Because there's big spikes up, everybody's scrambling to get stuff rated, and there's problems with disclosure, right? Voluntary disclosure, and then the way people are collecting stuff is complicated as well. But in a paper there is, that I know, there is a chart. I think in 2000, right around the end of getting close to 2010, there's a big spike upwards.
Okay. I somehow thought it was right after around 2010, 2012. So yeah.
Yeah. I don't remember stocks. Yeah, so I'm seeing that. I'll send you this chart we have over later. These are True Value Labs and OWL. These are aggregators. So I don't have the MSCI numbers, but it looks like the thing really takes off in 2009, according to that. And I think MSCI will tell you its coverage. And again, it's unreliable because MSCI will say, well, I won't cover Goldman Sachs for chemical spills, which is sensible in one way and not sensible in another, since they're probably funding them. But this is a tricky point.
But yeah, the reason I was trying to get a sense as to the timing is, if it overlaps with our data, we could at least try a little. But yeah, the issue is which one you want to use, right? And why do you think it's a good one? So
yep.
Vic, I have to scoot.
Yeah.
This is very interesting, and it's great to see you.
Good to see you too, Frank.
To see you in person soon. And
yeah,
thanks.
Same here.
Thanks.
Thanks for joining us, Frank. So I've talked a lot. Do we have any more questions from the audience? Not me and not Frank. Going once, going twice. Well, then let's thank our speaker. That was really great. Vic, thank you for
so
giving us a wonderful talk right off the plane. And next week at this very time, we'll be having Emilio Calvano from the University of Bologna with a different kind of topic, artificial intelligence, algorithm, pricing, and inclusion. So
Wow.
hope to see many of you then, and have a great rest of day.
Thank you so much. Thanks for all the comments.
Bye now.
Bye.